Well, welcome to this third webinar organised by the Money, Macro and Finance Society. It's the third in a series of 5 webinars that are taking place this week online, and we're evaluating the impact of COVID. Today, we're considering the monetary policy implications of COVID with a distinguished panel of experts. So let me make some brief introductions. First, we have Sir Charles Bean, who is Professor of Economics in the LSE and a Budget Responsibility Committee member at the Office for Budget Responsibility. He was Deputy Governor for Monetary Policy at the Bank of England from 2008 to 2014, and prior to that was the Chief Economist. In both roles, he sat on the Monetary Policy Committee. He's been an advisor to the UK and European Parliaments on monetary affairs and holds a PhD from MIT. We also have Loretta Mester, who is President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. In this capacity, she is a member of the FOMC, responsible for US monetary policy. Prior to assuming her current role in 2014, she was Executive Vice President and Director of Research at the Philadelphia Fed, having joined the Fed as an economist in 1985 after a PhD in Princeton. And thirdly, we have Kristin Forbes, who's Jerome and Dorothy Lemelson Professor of Management and Global Economics at MIT, where she also earned her PhD. Kristin was an external Monetary Policy Committee member in the UK from 2014 to 2017, and is currently a member of the Economic Advisory Panel for the New York Fed. Previously, she served as a member of the President's Council of Economic Advisors in the early 2000s, led by Greg Mankiw. Well, today we're going to have each of the panelists speak to us for 15 minutes, followed by a discussion, and there'll be an opportunity for you to ask questions. So we'll send you a reminder about that through the course of the presentations. So let me ask Charlie Bean to kick off the discussion with his thoughts on the monetary implications of COVID.
Well, thank you very much for that introduction, Paul. I should say that today I'm talking more with my LSE hat on than I am with my Office for Budget Responsibility hat on. The exam question that Paul asked me to attempt when he was planning this panel was the question of how much monetary policy ammunition was left. Indeed, I'm going to ask the question, or attempt to answer it, whether the bank, and particularly the Bank of England, is out of ammo. Now, let me start with the question of whether the policy rate should be lowered into negative territory, which is very much in the news at the moment, with the bank having written to the banks to check that they were in a position to implement a negative bank rate if that was the decision of the MPC. If I could start by going back to 2009, when I was on the Monetary Policy Committee, this was the question of how low bank rate could go was something that was a very live issue. And we were concerned that taking bank rates too low would end up squeezing banks' profit margins to such an extent that it might be counterproductive. And that reflected the fact that there's a downward rigidity in the interest rates on banks' deposits. And at the time, a large fraction of their assets had returns that were linked to bank rate. Now, the fact that profit margins would be squeezed raises questions about whether that would impair the availability of credit, but also at the time, it potentially might have led to the failure of some of the smaller banks and building societies. Obviously, we decided in early 2009 to stop at a half and relied instead on quantitative easing. Now, since then, there's been a certain amount of academic work, particularly by Marcus Brunnermeier and co-authors, to analyse a bit more deeply the question of the so-called reversal rate, the rate at which cutting the policy rate turns out to be counterproductive for the supply of credit. And their work highlights the importance of many factors in determining what the reversal rate is, the extent to which the policy rate is passed through to deposit rates, the composition of banks' assets, in particular how much of it is fixed income, the strictness of capital requirements, and the degree of capitalization or overcapitalization of the banking system. So there's a lot of moving parts, and that means that potentially the reversal rate is uncertain, it's state contingent, and one of the aspects that Brunnermeier brings out is that that reversal rate tends to rise as fixed income holdings mature. Now, the profit squeeze is something that can be ameliorated by the central bank tiering the rate that's paid on reserves so that a very low rate is only paid on the marginal holdings of reserves. But potentially you need to go into this sort of territory. My reading of the evidence from the countries that have so far put a foot in this territory, in Europe and Japan, is that it's unpersuasive whether this is a good thing to do. And certainly it seems to me a relatively unattractive monetary policy option, especially if you expect that it will be maintained for any length of time. And it does seem to me appropriate that the bank has been relatively cautious about going down this route. So what else is there? Well, the next obvious thing is more asset purchases, quantitative easing, asset purchases financed by an expansion in central bank reserves. Here, I think there's now plenty of evidence from event studies across lots of jurisdictions that quantitative easing is effective at lowering yields and raising asset prices. And in terms of thinking about how much room there is here, how much ammunition, in principle, there's a lot, because there's an awful lot of assets in the world that the central bank can buy. You don't have to stop with gilt. You can buy private debt, equities, fine art, you name it. And you can also, in principle, buy foreign assets as well as domestic assets. So there's a lot of road, but long before you get very far down that road, issues start arising. So what are the problems with further expansion of QE? The first thing to be said is that the effectiveness of asset purchases is going to be greater when markets are dysfunctional, as they were during late 2008, early 2009, than when markets are functioning relatively well. Secondly, very low long-term interest rates is designed to push investors into riskier assets. But of course, that may go too far, so it may generate financial stability risks. But more particularly, and especially as you wade into a wider range of assets, is taking the bank into political territory. As far as just buying government bonds go, it can look as if the central bank is engaging in monetary finance. The chart here shows gilt issuance by the DMO this year, together with the bank's asset the bank's gilt purchases through its asset purchase facility. And you can see they've been pretty much one for one. So that invites people to think that the central bank is just engaging in monetary finance. Now, what really matters here is not what's happening now, but whether the bank is free to unwind the purchases when the time is appropriate in order to meet its inflation target. But nevertheless, there's tension. If the bank is buying private credit instruments, as is the case in the EU, then there's the risk of credit losses. And it then becomes reasonable for people to say, well, why has the bank incurred these losses which rebound to the taxpayer at the end of the day? If the bank buys equities, it comes with control rights. Potentially, QE has impact on exchange rates, so may create international friction, and that takes us back to the currency wars debate. So there's a whole range of political issues raised by QE, and more so the more the central bank engages in it. A separate political dimension is raised by the distributional consequences of QE. QE tends to benefit those who already hold assets to the detriment of those who don't hold assets but would be expecting to buy them. So typically it benefits older people at the expense of younger generations. Now, if QE is short-lived, this may not matter too much, but sustained QE is again taking the bank into territory which looks really quite political. So I think it is quite important that the government must be a party, if you like, must own the fiscal and distributional consequences of asset purchases. Now, the way the system is set up in the UK, with the Chancellor having to formally accept any recommendation from the MPC before any assets are bought and free to say no if he wishes, I think is quite an important feature that helps to preserve the political legitimacy of QE. What about helicopter money, which people sometimes talk about as though it's an untried weapon? Well, from an analytic point of view, helicopter money is just the same as a temporary bond-financed cut in income tax or lump sum taxes, together with a permanent purchase of the bonds that are creating permanent QE. And I think there's several points to be made here. Once you look at it like this, first of all, reserves pay interest. So the wealth injection is smaller than it may appear at first sight. Secondly, the fiscal leg of this is not very effective. One would expect a temporary income cut to be largely saved if you just temporarily increase people's income. So if you're going down this route, it actually makes sense to be thinking of more effective and targeted fiscal interventions. But then thirdly, there's the question of how you make the distribution of money under helicopter money credibly permanent. And in principle, there's the inverse of the helicopter, Friedman's helicopter, a sort of Friedman vacuum cleaner, which could be used to suck the money out. And as soon as one recognizes this, one realizes that actually, whether the QE that has been undertaken, will be undertaken, will be permanent if and only if it's necessary to meet the inflation objective. So to me, we've come sort of quite close to undertaking something that's like helicopter money. because it will be permanent if it's required to meet the inflation target. So very much as Monsieur Jourdain in the Le Bourgeois Gentilhomme hired a very expensive tutor to tell him whether he was, or to tell him the difference between prose and poetry, and then was flabbergasted to discover that he'd been talking prose all along. I think we may have been doing something that's not a million miles from helicopter money already. What about more targeted interventions, credit easing policies? And here the bank's lending policies can directly support the supply of credit. So past examples of this include facilities like the Funding for Lending scheme and the Term Funding scheme. During the present pandemic, the bank's undertaken several actions in this territory. The COVID corporate financing facility, under which it buys commercial paper issued by larger firms. The Term Funding scheme for small and medium-sized enterprises, which has made cheap funding available to banks that are lending to SMEs. And then finally, on the macro-prudential side, they've lowered the counter-cyclical buffer to create extra bank lending capacity. I think it's worth noting that one could go beyond these sorts of things and actually directly subsidize lending by supplying funds to banks at below bank rate. And it's worth noting that there's no issue about a lower bound constraint here. But of course, what it is doing is providing what is essentially a fiscal subsidy to the banks. So it's quasi-fiscal, and obviously one would need to introduce something that prevented round tripping, where banks borrow at below bank rate and then simply deposit in their deposit account and then the margin. So there are things that can be done in this territory, but again, they're quasi-fiscal. What about changing the target? Well, Loretta will no doubt talk a bit more about this shortly. Here I'll just say that having a price level target or targeting average inflation over a run of years is a way of embedding a commitment at the current juncture to keep interest rates low for long. But the concerns that one might have with it are that once the emergency is passed and rates are being kept low and inflation has gone back potentially above what are acceptable levels, it's time inconsistent. And then secondly, there are issues about what happens if you have upside inflation shocks. And we had these in the UK in both 2008 and 2011, when inflation went as high as 5%. Now, had we been following a rule like this at the time, it would have pushed us into having even tighter policy during the recovery from the financial crisis. And really, this sort of policy, you want to be asymmetric. And the way the Fed have introduced it, it's not explicitly asymmetric at this juncture, but I think one needs to recognize that one might not want to stick to it in the case of upside inflation shocks. One could raise the inflation target, and Olivier Blanchard some years ago suggested raising it to say 4%. I don't think this is quite as costly, it's costless as people sometimes think. 2% inflation is pretty much like stable prices. At 4%, that's less the case. So you lose some of the value of having low inflation embedded. But more particularly at the current juncture, I think raising the inflation target would lead investors in nominal bonds to think this is just the first step down the road to trying to inflate away the real value of government debt. And of course, that is, the incentives to do that are all the greater given the emission of extra public debt during the COVID crisis. So let me conclude very quickly. I don't think the bank is strictly out of ammunition, but the key thing is that the available instruments are of uncertain effectiveness and or quasi-fiscal in nature. And I think the moral of this that is in general wants to shift more of the burden of managing demand in the future onto fiscal policy and fiscal instruments, and be less reliant purely on monetary policy as the main instrument for managing aggregate demand. And then as far as the current crisis goes, I think it's worth remembering that COVID is a shock that lowers both demand and supply simultaneously, the lockdown measures. It's unclear as the lockdown measures are relaxed, which recovers faster. So it's unclear to what extent you have an output gap, which is amenable to intervention of the normal aggregate demand management type, normal monetary policy. In this circumstance, the right thing is targeted interventions, targeted fiscal interventions of the sort government has carried out with the furlough scheme and the like, acting as an insurer of last resort to try and prevent the unnecessary destruction of jobs and businesses which are viable in the longer term when the pandemic is past. And that also means that measures that improve the availability of credit are also likely to be helpful. And also where structural change is going to be required as a result of the pandemic, facilitating that. And using fiscal policy in this way is obviously particularly attractive at the current juncture, given the low yields. As far as the bank's monetary policy actions go, as I already said, I think the actions to support the supply of credit were warranted. I think also the asset purchases, particularly early on, which were motivated as much as anything with maintaining financial stability in the face of the general dash for cash in the early springtime, made a lot of sense. But given that it's not clear how much of a conventional output gap there is, it seemed to be less obvious that the appropriate policy response, at least so far, has been a general stimulus to aggregate demand through lowering the policy rate. Now, that may change as we go into the future, but certainly as regards the past, that seems to be a less well-honed instrument. So I will conclude there. I'm sorry, I've overshot a wee bit. Paul?
Thanks very much, Charlie. That's great. So let me now pass straight over to Loretta, who's going to speak for 15 minutes.
Okay, thank you very much. And Paul, thank you very much for inviting me to speak today. And I like how Charlie put it, an exam question. We were given an exam question and you asked me to speak about the changes that the FOMC recently made to our policy strategy. And I'm happy to do that. And of course, the views I'm going to talk about today are not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. They're my own views. So let's see if I can get this to run here. So in early 2019, the FOMC began to review our framework for setting monetary policy. And the framework includes the strategy, the tools, which Charlie just talked about, some of the tools, and the communications we use in setting policy in pursuit of the monetary policy goals given to us by the US Congress. And in the US, those goals are maximum employment, price stability, and moderate long-term interest rates. And when prices are stable and the economy is at full employment, long-term interest rates are typically at moderate levels. So it's often said that the US Congress has given the Fed a dual mandate of price stability and maximum employment. Now, the framework review was informed by the experience we had in setting policy during and after the Great Recession, by economic theory and empirical analysis, and by consultations with academic researchers and practitioners at research conferences. And it was also informed by conversations with the public at large. There was a series of what we called Fed Listens events held across the country. Every reserve bank held one. And there were other conversations that held in Washington with the Board of Governors. And the main conclusions of the review were captured in what we call our statement on longer run goals and monetary policy strategy. And the FOMC approved that in August. Now, the reason we undertook the framework review was to really take on board the changes in the economic environment that's emerged since the FOMC's first strategy statement, which was published in 2012. And one of the changes that has important implications for monetary policy is the decline in the US and in other advanced economies in the general level of interest rates consistent with sustainable growth and price stability. And this decline reflects a number of factors, including the aging of the population, changes in risk preferences, and slower productivity growth. And what it means is that the level of the federal funds rate, our policy rate in the US, consistent with maximum employment and price stability, is now lower than it's been in the past. So that means that during economic downturns, it's now more likely that the funds rate will be constrained by its effective lower bound, and the FOMC is going to have less policy space to support the economy using its traditional policy tool. Now, this constraint, which is understood by households, businesses, and financial markets, imparts a downward bias to inflation and inflation expectations. And so it really increases the downside risks to our achieving our policy goals. Now, another change in the economic environment with implications for monetary policy pertains to inflation dynamics. And resource slack in the labor market and in product markets has become less correlated with actual inflation than in the past. And inflation expectations now are playing a larger role in determining inflation outcomes. So this means it's even more important that the inflation expectations remain well anchored at levels consistent with our longer run inflation goal. If expectations move below those levels, then it's more likely that inflation itself will run below our goal, which would then result in even less policy space in a low interest rate environment. So these changes in the economic environment warranted asking ourselves whether there were revisions to our policy strategy that would make it more effective in promoting our policy goals. And the review we undertook led us to conclude that the answer was yes. We made changes to both our approach to inflation and our approach to our employment goal. And that is what's summarized in that revised strategy document. So regarding our approach to inflation, the first thing I want to note is something that did not change. The FOMC has reaffirmed the explicit inflation target first announced in 2012, namely that a longer run inflation rate of 2% is most consistent with our statutory mandate. And Charlie mentioned that, there has been a conversation about whether that goal should be raised. And I agree with him that I think a higher inflation goal is probably not the best approach. So I'm happy that we reaffirmed a 2% inflation goal as being consistent with our policy goals. But now the statement is much more explicit about how we're going to go about achieving this inflation goal. In particular, it states that after periods in which inflation has been running persistently below 2%, we'll likely aim to have inflation run moderately above 2% for some time. The intention is to help anchor inflation expectations, which has become a main determinant of actual inflation at levels consistent with 2% inflation. So this new language is a stronger statement than we've made in the past, as we've kind of struggled to effectively convey that the longer run goal of 2% should not be interpreted as a ceiling on our inflation rate. Now, in the past, many of us on the FOMC have indicated that we'd be comfortable with inflation running above 2% for a time because it had been running low for so long. So that was a type of what was termed opportunistic reinflation. But now we're going to be deliberate rather than opportunistic. And as the revised strategy indicates that, once inflation has been running persistently below 2%, not only are we going to tolerate serendipitous shocks that move inflation above 2%, but will likely set policy with the intention of moving inflation moderately above 2% for some time. And the implication is that monetary policy will be somewhat more accommodative than in the past when inflation has been running persistently low, and with the aim to reach our longer run inflation goal. Now, regarding our employment goal, I view the changes we made in the strategy statement as an acknowledgement of the uncertainty around assessments of the level of maximum employment and a clarification to our approach to achieving that goal. And this is consistent with something I've advocated for some time, that policy communications should acknowledge uncertainty. Now, in the recent expansion, pre-COVID expansion, we saw that employment growth could be stronger and the unemployment rate lower without generating inflation than one would have thought possible based on past decades of experience. And over the expansion, it took us some time to learn about the structural changes in the economy. And as the FOMC learned, it did move down its assessments of longer unemployment. And they came down pretty significantly. And from a historical perspective, I'd say they came down pretty fast. But unfortunately, it did take time to learn. That time to learn, combined with the previous strategy statement's references to deviations of employment from maximum employment, has sometimes been misinterpreted as suggesting that the FOMC at times takes deliberate policy action to bring employment down independently of our inflation goal. And that's not the case. I think everyone on the FOMC, although I'm only speaking for myself, of course, understand the benefits of a strong labor market in fostering economic inclusion. And I think those are clear. But I think changes in the economy really have now underscored the difficulties in using the Phillips curve model to forecast inflation or to assess maximum employment in real time. And I think the revised strategy statement clarifies that in the absence of inflationary pressures or risks to financial stability, strong employment is not a concern to the FOMC, and monetary policy will not react to it. So this approach is consistent with the recent behavior of the FOMC. The Cleveland Fed staff maintains a set of simple monetary policy rules that we publish on our website. And if you look at those estimates and re-estimate them, you'll see that the FOMC participants put less weight now on the unemployment rate in determining the appropriate path of policy. And they've done that over the past 2 years of the most recent expansion than they did earlier in the expansion. So I think, the changes in the strategy statement on employment are largely consistent with how the FOMC has been behaving. Now, the new strategy statement is going to be guiding our monetary policy decisions both during and beyond the pandemic. But I think bringing the new strategy to bear in our policymaking is a work in progress. So I'm going to end my remarks by discussing 2 areas for further work. First, systematic policymaking and communications. And second, the nexus between financial stability and monetary policy. So our September FOMC policy statement was the first that incorporated a new strategy. And the strategy did indicate that because inflation has been running persistently low, we're going to aim to achieve inflation moderately above 2% for some time. And we expect to maintain our current funds rate target, which is 0 to 1/4%, until labor market conditions have reached levels consistent with our assessment of maximum employment, and inflation has risen to 2%, and is on track to moderately exceed 2% for some time. If you look at the summary of economic projections that were released in September, the forecasts of all the FOMC participants showed that the majority thought it would not be appropriate to raise rates until after 2023. But I think it's important to note that the guidance that is in the statement is based on the state of the economy and not on calendar dates. if the economy evolves so that the stipulated inflation and employment conditions are achieved earlier or later than currently projected, then the anticipated policy path would appropriately adjust. So I'm a strong believer in clear policy communications. I think they are really an important part of effective monetary policy making. And I do believe that when the public has a better understanding of the goals and rationale for monetary policy decisions, they're better able to hold policymakers accountable for their actions. And they also make policy more effective by providing the public with information about the economic outlook and aligning the policy expectations about future policy actions. Those public expectations with what policymakers are thinking. And that also helps, households and businesses make better economic decisions and financial decisions. Now, even though the September statement incorporated the aspects of the new strategy, Fed watchers and others have asked for more context about the indicators that the FOMC would be using to assess whether labor market conditions are consistent with maximum employment and how far above 2% would the FOMC aim for inflation to be and for how long. So the context certainly has changed, but those kind of questions about how the FOMC assessed whether or not its goals had been met or not, those were asked when we were operating under the previous strategy as well. And I think that's just, we just really need to work harder as we did before to ensure that our policy decisions are systematically guided by our outlook and risk around the outlook, and that our policy communications can convey a good sense of the FOMC's reaction function. And I think now with the change in strategy, that's even more paramount. And I think that's something we're going to need to work on. The revised strategy leans heavily on the relationship between inflation expectations, inflation, and the ability of monetary policy to influence both. But I'd say there's still a lot to learn about inflation dynamics and inflation expectations. And the benefits of a move to a type of makeup strategy for inflation, that is running policy to achieve inflation somewhat above 2% for a time after it's run persistently low, that really depends on our ability to communicate that we've shifted to and will pursue this new strategy, and our ability to explain clearly how the new strategy differs from the old. So recent research from the Cleveland Fed Center for Inflation Research suggests that we may have quite a bit further to go on this score. So the center's researchers used the Cleveland Fed's daily national survey of consumers to examine the effect of Chair Jay Powell's announcement of the new strategy on households' understanding of monetary policy and their expectations of inflation. And they obtained 4 interesting results. First, while there was a surge in news coverage about monetary policy around the time of the chair's speech, there was only a small increase in the number of respondents who reported having heard news about monetary policy. Most people did not recall anything about it. The second finding was that among the small group who had heard the news, there was a sense that something had changed, but little recognition of what had changed in the approach to monetary policy. Third, there is considerable confusion about the FOMC's monetary policy goals. When presented with a list of options, more of the respondents said that the Fed sets monetary policy with the aim of maintaining a strong dollar or keeping interest rates low to reduce the government's cost of borrowing, than said that we set policy to promote maximum employment and price stability. And fourth, when some individuals were selected at random and given information about average inflation targeting, their expectations about future inflation over the next 5 years were no different than those of individuals who were instead given information about traditional inflation targeting. Now, it's important to remember that some of the gains from the new strategy will likely come from the expectations and actions of sophisticated financial market participants who are close followers of monetary policy, and that'll help the policy transmit through the economy. And it's also true that the survey was taken only a short period following the announcement. And as anyone who's ever taught or been a student knows, it takes time to master new material. But the results do suggest that we need to do a lot more work on our policy communications to ensure that households are going to understand the policy strategy and then incorporate it into their expectations and actions. Now, another area that needs further work is understanding the nexus between monetary policy and financial stability. The revised strategy statement explicitly acknowledges that sustainably achieving maximum employment and price stability depends on a stable financial system. And as part of the framework review, the FOMC did consider the interactions between financial stability and monetary policy, particularly in the current environment of low interest rates. While monetary policy leads to a stable macroeconomy and thereby encourages financial stability, it's also possible that in an environment with low neutral rates, a persistently accommodating monetary policy could, in some cases, increase vulnerabilities of the financial system by encouraging higher levels of borrowing and financial leverage, increased valuation pressures, and search for yield behavior. And how best to approach the nexus between monetary policy and financial stability in a low interest rate world deserves more consideration. If you look at the minutes of the January 2020 FOMC meeting, that's where we discussed the framework and financial stability issues. And you'll see that most FOMC participants agreed that supervisory, regulatory, and macroprudential tools for the US, those are countercyclical capital buffers and stress tests, that those tools should be the primary way to address financial stability risk rather than using monetary policy. But in the US, we don't have that many countercyclical tools, and they're not designed to address vulnerabilities outside of our banking system. And so I think there may be certain circumstances where monetary policy may need to be adjusted in order to mitigate risks to financial stability. But how and when to do that needs further study. I also think that we need more study to really understand the trade-offs and complementarity among our three sets of relevant policies: macro or monetary policy, macroprudential policy, and microprudential policy, which would include our capital and liquidity requirements that work through the business and financial cycles. I think the implications of a low interest rate world for monetary policy is one thing our framework review took up. But I also think we need to study the implications of a low interest rate world for macroprudential policy and microprudential policy. So that ends my remarks, and I'm looking forward to the discussion. Thanks.
Thanks very much, Loretta. So let me pass straight over to Kristin, who's going to make the final presentation.
Okay, so we have just heard about some important developments in the US from Loretta, and also some of the major issues in the UK from Charlie. So what I was going to try to do is link these developments to what's really a striking transformation that occurred in central banks around the world, started by their responses to the global financial crisis in 2008, and then in a sense doubled down on in response to the COVID pandemic. So before I start, just a little background, this transformation happening in central banks is not out of the blue. There has been an evolving role of central banks over the decades. Since we started with the UK, going back to the UK, Montague Norman, the Bank of England governor in the 1920s, 1930s, he's famously known for hiding within the imposing walls of the Bank of England, saying things like keep the press out of the bank and the bank out of the press, being very secretive. There was already a remarkable evolution to the days of, say, 1998, when the collapse of LTCM led to financial market turmoil. And the response was the committee that saved the world, as Time called them, led by a central banker, Alan Greenspan. So central banks had already been taking on a greater role, more power, more public presence, more transparency. But I want to focus on the evolution that's happened in the last 12 years. It's launched by the global financial crisis, how central banks have really taken on a fundamentally new role, new tools, new expectations for what they can do, and how this creates a number of tensions and risks going forward. And to make this a little more fun as I answer my exam questions, I want to focus on the theme of if central banks have crossed the Rubicon. Back to history, The Rubicon, or the famous crossing of the Rubicon, was in 49 BC when Caesar led his army across the Rubicon, a small river separating Gaul from Italy. This may not seem like a big deal for an army that had traveled many miles, but this broke the Roman law, which forbade a general from leading his army out of the province to which he was assigned. In this act, this crossing of the river sparked a civil war, gave Caesar unparalleled power as the ruler of Rome for a period, but then fundamentally changed the governance of Rome forever after, launched the Roman Empire in many ways. So I'm going to ask if central banks, the actions they've taken, this expansion of powers, the changes in the role, have in some ways crossed the Rubicon for central banks. And more specifically, in that framework, I'll answer the 3 questions I was given. How have their responses crossed important lines? Not only some of the obvious ways, but some potentially even more transformational ways. Second, have these actions meaningfully supported incomes and growth? And then finally, what are some of the risks involved from crossing these lines? So let's start with the first one. How have central banks crossed important lines? How have they possibly crossed the Rubicon? So an obvious place to start is just the massive scale of central bank interventions. For example, if you look at QE, the asset purchases, this is a scale of central bank intervention we hadn't previously seen. But what I think is equally important, potentially even more important, is the justification for these actions, especially the justifications we've seen in many of the policy and announcements in March of this year in response to the market turmoil around COVID. What really struck me is in March of this year, how when the emergency measures were announced, large QE packages were announced, the language focused on, to use language from the Bank of England, preventing market dysfunction, stabilizing markets was central. There was very little discussion in this period of March when some of the packages were initially announced about price stability, about inflation targets, or even about stabilizing growth and employment. It was clearly a focus on market dysfunction and market stability. Granted, later on, central banks explained how preventing market dysfunction is important for price stability and economic stability. But at the period of March, when many of these programs were launched, we didn't understand the extent of the economic damage that was coming. Market dysfunction was clearly the motivating factor. So I think that's a very important change. For some, it confirmed that there is a central bank put, that central banks support markets more now than they did in the past. But this is just a shift in communication that I think has been very important. It raises a lot of questions too going forward about what is market dysfunction? What is enough market dysfunction to justify intervention? And what markets matter? What markets would get some support? So a second major change in the role of central banks and the role they've been playing is the amount of direct and indirect credit risk and the related corporate governance concerns. Charlie touched on some of these, and I think these are very important. One level is just the potential fiscal losses that central banks could take on. Every country has different arrangements for all the different actions they've taken, different backstops, different links with the fiscal authority on who's going to assume any underlying risk. But here's just one estimate from the BIS on the size of the fiscal measures linked to what central banks have announced, as some of the major central banks have announced in response to COVID. This is not only potentially has some fiscal implications, but it also has implications because central banks have now stepped into markets where there are a whole set of governance issues. For example, central banks have stepped in, and again, varies across countries, but they've stepped in commercial paper markets. They bought below investment grade credit or supported those markets. In the US, there's purchases of state and local government debt, some of which do not have the soundest fiscal backing or fiscal frameworks. This is a very different role than in the past. I think back to even in 2008 when the US bought in and bought some of the GSE assets and got involved in housing and mortgages. That was a big line to move there away from government debt. And now what central banks are owning is another whole league of risk. And that raises a whole set of implications, not only the fiscal risk, but also if there is a time it makes sense to raise interest rates to support price stability, that could higher borrowing costs could push some of these entities, of which central banks own the assets, into bankruptcy. How will they handle that trade-off? Also, if central banks own all sorts of assets, they could be exposed to risk if there's some corporate governance issues. What if a CEO is charged with misconduct when the central bank owns some of the assets related to that company? What if the company is involved in child labor, polluting the environment? A whole set of issues that central banks could be drawn in if they own stakes in some of these companies. So very different position than just holding even government debt. A third important line that has been crossed is how the shift in frameworks is allowing central banks to talk about a very different set of goals and issues. Loretta was very careful in how she phrased the changes in the framework are still focused on the mandate of price stability, full employment, per the Fed's mandate. But there are some speakers who aren't as careful. And now that many central banks, not so much the UK, but many other central banks are less worried about inflation, more focusing on employment. And now there's some more freedom to let unemployment get lower, less concern about inflation, so they can talk more about things like bringing different people back into the labor force, even more talk about inequality, addressing workers at the lower end of the scale who you can bring in by keeping rates low for longer, or maybe running a hot economy. Again, central bankers are usually very careful in exactly how they talk about this, but it is opening up a conversation where central banks seem to be potentially playing a role addressing issues that are not directly inflation, but related to bringing different types of workers into the labor force, addressing inequality, and potentially even changing the structure of economies and potential growth rates. That's a very different type of discussion than just having central banks stabilize prices and growth around a fixed potential growth or structural growth rate. There's now more discussion about central banks can actually change the structure of the economies. So very different framework for discussion that opens up a whole set of other issues. And then a final important line that has changed over the past 12 years, especially in response to COVID, is what is happening in emerging markets. Emerging markets are using QE much more widely than I think anyone would have predicted even 2 years ago. But I call it, what emerging markets are doing is not just QE, I call it QE plus. Emerging markets in some cases are using QE even when interest rates are not at their lower bounds. So that's quite different than most of the advanced economies. For example, Indonesia and South Africa have policy interest rates above 4% when they launched QE. So it's clear QE is not just because you can't lower the policy interest rate more to provide stimulus, it's being used for additional reasons. And also, some emerging markets have shifted very quickly to not just doing QE where they buy government assets in secondary markets, but they're buying government debt directly from the government and directly from treasuries. For example, the Philippines has done that. South Africa purchased treasuries directly and explicitly said it's not to stimulate demand, but to ensure a smoothly functioning market. So these are some very different roles. A very important line has been crossed, especially in emerging markets, which were previously very worried about looking like they're financing government deficits. And there could be some longer term implications for credit spreads and borrowing costs. So that's just a start of some of the very important lines that have been crossed in central bank responses to COVID, building on a number of changes that were started after the global financial crisis. So have these helped? Have these actions meaningfully supported incomes and growth? In my reading of the evidence is yes. Without a doubt, this strong policy response by central banks has lowered borrowing costs. It has made it easier for indebted people to keep financing that debt or roll over that debt. Been particularly important for companies who needed access to credit to bridge them through this extremely difficult period. These very different credit facilities that have been backed up have certainly been important in supporting companies. Also, very important is lower interest rates have made it easier for governments to borrow and made it easier for them in turn to run large deficits to support fiscal packages. So I think I won't belabor this point because I think it is fairly obvious that all these actions taken by central banks have helped. They have provided meaningful support for incomes and growth through a variety of channels. But also, I think it is important to put that in context. While that has helped, certainly moved in the right direction, most of the evidence I've seen so far suggests that the fiscal actions taken by governments have been more important in terms of supporting incomes and growth. For example, at University of Chicago just released a nice study, and they found that 76% of workers in the US received more from claiming unemployment insurance under the CARES Act than they would have gotten in wage compensation. These types of effects were very large, especially for individuals' incomes, and much larger than what probably central banks accomplished. So central banks have not acted alone. The fiscal support has been very important, arguably more important, but central banks, the actions they've taken have also been helpful in supporting incomes and growth. So the final question I've been asked to address is, what are the risks involved? So when Caesar crossed the Rubicon, there was the short-term cost of starting a civil war. That was probably expected. Probably harder to predict was some of the longer-term implications of crossing the Rubicon, of these fundamental changes. It did give him the ability to enact some of the reforms he wanted. He started the Julian calendar, land reform. He enacted a number of populist policies, support for veterans. But it also fundamentally changed the structure of governance in Rome. There's a period of his unparalleled power, and then there was a period of turmoil after his reign ended. But then basically the Roman Republic was never restored. This launched the period of the Roman Empire and many infamous emperors. So are there some equal short-term and potentially long-term risks in governments and structure based on these important steps central banks have taken? So a lot of risks I could talk about. One risk you hear some people worry about is inflation picking up faster than expected. Inflation has bounced back in a number of economies. I could certainly tell you a positive, optimistic scenario that I wish would play out, although it's certainly not my base case. There could be a scenario we get a vaccine soon. It is able to vaccinate a large portion of populations quickly. People quickly are free to return to business as usual. They have pent up demand, especially many whose savings have increased. They can't get enough of going to the movies and going to watch football games. And companies are comfortable raising prices, partly to pay for the past costs of dealing with the pandemic. And you could see inflation pick up faster than expected. Again, not my baseline case, but it is one potential scenario. Other risks that you can worry about going forward longer term, because of this era of very low rates, because of the sense that central banks will intervene more quickly to support market dysfunction, you could increase the risks of more bubbles, more financial market bubbles, if there is a sense of this backstop from central banks. Other risks you hear about are greater risk of zombie companies. As some companies that may not be solvent even after there's a vaccine for COVID, due to structural changes, these companies may be able to stay afloat for longer because of their easier access to credit from all these new programs started by central banks. Also risks that as central banks have been asked to play such a public role and become involved in issues other than just around price stability or maximum employment, they may be expected to play an even greater role in a broader set of issues going forward. So lots of risks. But my take from looking through these risks is we need to be cognizant of these risks. We should discuss them, keep them on everyone's radar, but many are risks that can be dealt with careful thought and attention. So for example, back to the inflation risk, which you hear some about, or some people are worried about. So if you are worried that inflation will pick up faster than expected once there is a vaccine, that's something central banks know what to do with. Then they should reduce stimulus. when appropriate, raise interest rates, cut back on QE. So that's something that, as long as central banks are careful not to tie their hands, as long as they keep the options open to raise interest rates sooner than maybe baseline expectations now, that is the risk of inflation is something we can deal with in the future. I think more difficult is concern about financial bubbles building in the future because of this period of very low interest rates for an extended period. This is harder, but here I think especially the UK has shown us how you can start to address these risks through macroprudential policy. Since the global financial crisis, there has been very impressive advances in developing macroprudential tools, starting to use these tools. And this is an area where I'd like to see central banks act more aggressively going forward to use these tools. It's hard in the US given the institutional framework, but these tools are going to be important to ensure that this risk of more bubbles, financial market inefficiencies building don't occur. Other risks, for example, of zombie companies being kept afloat by all these new lending programs, I think that's another manageable risk to make sure that this emergency support for different markets, purchase of his assets is short-term, and to make sure as much as possible these are bridging programs to get us through this difficult period when financial markets aren't providing credit, but make sure those can be wound down for companies that are not solvent and shouldn't continue to have access to credit. And then in terms of central banks taking on greater roles in a broader set of issues than explicitly in their mandates, that's something that I think central bankers just need to be very cognizant of and aware of, is even if they have been handed all these powers, if they are given the opportunity to weigh in on a broader set of issues, just to be careful not to grab too much power, not to do what Caesar did, to take on too much power and hold it longer than needed, to ensure that they stick to their mandates and stick to the guidelines they have been given. So bottom line is, I think central banks crossing these important lines, taking on these new steps, stepping into these new roles does raise a number of risks. But these are manageable risks. With awareness of these risks, paying attention to these risks, and being careful to differentiate between what was done in a real emergency situation versus what is business as usual will be important. So just to conclude, when Caesar waded into the Rubicon, took his first steps, supposedly he said, "Alia iacta est," the die is cast. There is no going back. So similarly, from the viewpoint of central banks, there really is no going back to the pre-COVID days or pre-global financial crisis days. The actions that have been taken in response to COVID, building on earlier steps, have been an important part of stabilizing economies and supporting recoveries. And central banks will be expected to play these roles in the future. There is no going back. But as this fundamental transformation in the tools central banks use, in the institutional structures, in their role has occurred, this does raise risk going forward. And I think that this is going to be a very important sort of next 5-10 years in trying to find the right balance between using these new tools, using these new powers effectively, but also not overstepping. Thank you.
Thanks, Kristin. That's great. Let me just remind everyone that there is an opportunity to ask questions through Slido. So we'll perhaps get the screen that shows you the number. 888-003 is the number, the event code at slido.com. So please do submit your questions. In the meantime, let me, since we've been referring to exam questions, let me set a few more for you to think about. So I was thinking in the context of the frameworks of for central banks. What makes it appropriate at this point in time? We are in the middle of a pandemic, after all, to make changes to monetary policy objectives. And if it really is necessary to do these things, why didn't we do them earlier? So maybe I could ask Loretta to kick off on that one, and then others can chip in.
So thanks, Paul. So it's a good question. You know, the Fed started their framework review pre-pandemic, right? So, and there was a sense of, okay, the recovery and expansion is, you know, well underway. We had moved almost basically to full employment and to price stability. And it was a good time to sort of now take a step back and really look at our strategy for policy. And given the changes in the economic environment that I talked about in my prepared remarks, and also what we've learned in using the new tools that we used in the Great Recession. So that work had started, last year, well before the pandemic, and a lot of progress had been made. Of course, this year when the pandemic hit, that work was slowed down, and put aside for a while because we had to really address the issues. But then, we didn't want to hold it back. We wanted to continue on. And so that's why we released it. But the thing to note about it is that it really is very supportive of the policy actions that we've taken to address as much as we can the disruption in the financial markets that we experienced in February, using our emergency lending powers, and then also what we did with monetary policy in terms of making sure that we're supporting both maximum employment and price stability. So I think it actually is a reinforcer of some of the actions we've taken to support the macroeconomy. So I don't see that it replaced anything. I think in some sense it was actually a good time to bring it out and sort of be more explicit about how we've been running policy and how we really think policy should be run during the pandemic, but more importantly, as we get out of the pandemic scenario.
Great. Well, Charlie or Kristin, perhaps you can respond. And do you think that other central banks should follow the Fed's lead? Is now the right time for that?
Shall I go first?
Yes, go ahead, Charlie. Yeah.
First, I would say I don't regard where the Fed has gone as being a major change in the regime. It's an evolution rather than a revolution of the regime, and reflects the realities of the state of the economy that they're dealing with. Now, you can always say, well, maybe you could have thought of all of this earlier and introduced it earlier. It's fair to say that there had been some thinking about maybe central banks should have price level targets rather than inflation targets some years ago. So the Bank of Canada were looking at this at about the time of the financial crisis, just before the financial crisis broke, which rather pushed it off the agenda for a while. I have to say, I think one of the most important tweaks in the Fed's strategy is going to be less the switch to average inflation targeting and so forth, but more the focus on the maximal employment objective, and in particular, the move to saying, well, we're not going to tighten policy until we think the objective is achieved, which is a move away from the preemptive approach that would recognize there are lags between changing policy and its impact on the goal variables, where central banks would start tightening well before they got to what they thought was the natural rate, to something which is closer to cautious experimentation. Now, I should say that 25 years ago, in my former life as an academic, I gave a paper at Jackson Hole where this was one of the suggestions, that if you're uncertain about the supply side of the economy and where the limits to expansion are, it makes sense to cautiously experiment. I should record that I did get my head bitten off by Alan Greenspan and Alan Blinder at the time, but nevertheless, these thoughts were around in the fraternity.
Thanks very much. And Kristin.
Yeah, I'll expand. I agree with both of those comments, but expand on both. So as Loretta mentioned, the changes in the Fed framework aren't something that came about because of COVID or the response to COVID. Yeah. And these discussions have been happening for a long time and building on the experience after the global financial crisis. And I think I'll give them credit. They did wait for quite a while to see inflation undershoots, to really think this through carefully and deliberately. And it was a long-term discussion. But here they have also been lucky in that the changes that were sort of coming out of that also could reinforce steps being taken now and help make it, they made sense in the context of the COVID pandemic to help recover faster. So a lucky coincidence there that everything worked in the right direction. Should other central banks go that way? I think it very much depends on the central bank. Some of the lessons the Fed has learned do apply to other countries. It is a lot harder to know what the natural rate of unemployment is. It is a lot harder to set monetary policy today based on where you think things will evolve in a couple of years based on a model of the structure of the economy. I think that's a very important lesson. It applies in the UK. I know I struggled with that quite a bit in the UK, trying to figure out when to adjust rates. So that's a lesson. But yet in the US, one of the big concerns has been the inflation undershoot, as in some other countries. But the UK, for example, doesn't have the same issue. I put together some numbers recently, and inflation has overshot 2% in the UK more months than it has undershot since the 2008 crisis. So there you have to be careful, I think, putting in some of the changes that might lead to higher inflation, inflation expectation aren't as important in other countries. The situation does matter. Also, the flexibility already provided matters. The UK, we always found it very helpful. It wasn't about setting interest rates to get inflation at 2% today. It's about getting inflation at 2% out in about 2 years' time. So that gives you quite a bit more flexibility to take into account that other central banks may not have. So the UK doesn't seem to need that additional flexibility that the US is hoping for. And then the final point, I just want to reiterate what Charlie said. I also agree that at least my read of the changes to the US mandate, the biggest one is that the weight it's putting on employment, just admitting it doesn't know where that neighborhood is, that you may be able to push unemployment lower, that you need to wait to actually see signs of inflation, not trust it'll come based on where the unemployment level is. That's a more fundamental change. That will mean central banks will be slower to raise rates than they have been in the past. That makes the job a lot harder too for central bankers, because there's always different inflation measures and ways to look at inflation and different indicators and different things to cut out. So there's going to be more flexibility in interpretation than there used to be when you stuck more to the rigid models based on where unemployment was. So I think that's a very fundamental change. Again, just giving central banks a bit more flexibility to adjust to the circumstances.
Thanks. So let me ask one more question, then I'll pass over to the audience for questions. We've talked quite a bit about the reach of central banks and also the way that central banks have adapted their methods using instruments that are quasi-fiscal in nature. Do these extensions to the reach of the central bank and also the use of quasi-fiscal instruments risk politicizing central banks, and does that endanger their independence? Maybe Charlie could start on that one.
Yes, okay. Well, I have to say I think we need a more nuanced view of central bank independence. I think one of the problems with the literature is that it talks about the institution as being independent. It's a sort of rather monolithic concept. And of course, the whole press for central bank independence was very much more brought about by the high inflation of the 70s and the apparent inflation bias when policy was left to purely to politicians. But I think we should recognize that really all central banks are creatures of the state. Now, obviously their setups differ from country to country, but at the end of the day, they're given their power and legitimacy by governments. We talk about Bank of England independence. The Bank of England is not independent. It's 100% owned by the Treasury and has been since it was nationalised after the Second World War. And even before it was nationalised for the first 250 years, its powers were still circumscribed by the fact that it periodically had to have its charter renewed. by the government. And I think we need to move to thinking about central banks having delegated powers in certain areas. Obviously, in the case of the Bank of England, it's in the execution of monetary policy, the deployment of macroprudential tools and so forth. But there will be other areas where it's perfectly appropriate for the fiscal authorities to be involved and possibly to be in the lead. So, for instance, when you have bank failures, as soon as there are any risk to public money in financial instability episodes, the Treasury becomes in the lead, and there's a memorandum of understanding that makes that clear. So I think the important message to take away from where we are is not to throw our hands up in horror and say, oh my God, central bank independence is coming under threat here or risk or whatever, but to recognize that some of the areas that they're moving into involve cooperation with the fiscal authorities, and in some cases the fiscal authorities may need to be in the lead. And then the important thing is to develop governance arrangements, institutional arrangements, which make sure that operates effectively and doesn't create problems.
Great, thank you very much. Kristin, do you want to chip in here?
Sure. So I will admit I do worry about this quite a bit, and from a couple of different angles. One angle is the way that central banks jumped in when treasury markets weren't functioning well and when governments were having trouble selling their debt this March. And then the way emerging markets are directly coming in to finance deficits. These are lines, thresholds, the line has moved quite a bit in the past few months. And I worry about how we get back to a more normal functioning. I think no one expects, when things calm down, central banks to jump in and start to directly finance government debt, or at least in the advanced economies right away. But when there's a failed treasury auction, what justifies intervention in the future? A small failed auction, probably not, but how big is too big? How much turmoil, how much dysfunction is too much? I think these are important issues that it would be helpful to think about in advance and at least try to lay down some guidelines. So there isn't a sense that there's a central bank put under treasuries. We don't want to get to that world. So I think that's, again, another really important set of discussions so that we can keep that independence. And yes, central banks will step in extreme periods like in March of this year, but how to make sure that is really only super extreme events and not business as usual. The other related issue that I worried quite a bit about when I was at the Bank of England was, as central banks are buying some different assets, the exposure they get. Charlie talked about this. So we launched the corporate bond scheme after the Brexit vote to stimulate the economy. Small scale compared to what's happened the last year. But this is the first time the Bank of England actually bought corporate bonds of individual companies. And I did worry quite a bit about, what if one of those bonds we're holding, something happens in that company that is embarrassing? The Bank of England can't be expected to micromanage every risk of every bond they hold, but you could see the headline risk. And so we worked very carefully to have the purchases done in attempted to be sort of a market neutral way, just matching indices done by a separate group of people to try to be as hands-off as possible. It seemed to have, I don't follow the UK papers as closely as I used to, but it seemed to have worked. There doesn't seem to have been any major scandal and where there was a headline, Bank of England owned X and this went wrong in X. That hasn't happened yet. But as central banks have bought more and more of these assets, the risk is going to increase. And at some point, there's going to be one of these headlines. So again, it's going to be very important to think through how these purchases are structured. So as much as possible, it's a couple steps removed, and central banks aren't seen as being responsible for governance issues and other issues that happen in these companies. But the risk is out there now. And I think it is unfortunately a matter of time till that one of those headlines comes up.
Okay, thank you. And Loretta, what do you want to say on that?
Thank you. So I agree with both what Charlie said and with what Kristin said. I think it's really important that we understand the risks that we're taking on. And for the Treasury market, it seemed clear to me, given what was happening in that market, that fully fell under the purview of the Fed taking action to make sure that markets were functioning. That's an incredibly important market, global market. But understanding, okay, what caused that kind of disruption? Are there structural issues in the way the Treasury market has evolved over the past 10 years or so that made it more vulnerable to that kind of dysfunction? I think that's the kind of focus that I would like to have, so that we understand what the risks are, and then we can appropriately, not the Fed, but the right bodies could actually change the market structure if necessary so that it's less vulnerable. So I think work on sort of understanding the resiliency or lack thereof across markets is an area that I think we're a little bit behind on. And I agree that the UK has a better system in thinking about the nexus between financial stability and monetary policy than I would say that we have in the US. And I think that's certainly something that we need to worry about. I'm less worried about the emergency lending facilities in the US than perhaps Kristin is, because the terms of those facilities really are set so they don't crowd out private markets. They really are backstops. And if you look at some of the uptake on some of those facilities, you'll see that it hasn't been that much. But the perception, I think, is one of the things Kristin's pointing out, is that there is a perception that perhaps we are doing things that aren't appropriate. And I think that's where better communication about why we're doing it, what we're doing it, and being able to exit those facilities in the appropriate way and at the appropriate time is going to help our credibility on that score.
Fantastic. Thank you very much. I'm conscious the audience hasn't had a chance to ask any questions, so let me hand over now to Miguel, who will ask a few questions on behalf of the audience.
Okay, so thank you for your presentation. Not very many questions. You've been crystal clear in your presentations. There is one question that is related to something that Kristin said about how central banks have acted to stabilize financial markets. And it's also related to Charlie Bean's plot, in which is showing purchases of treasuries and issuance of treasuries. So the question is it a coincidence that the amounts of purchased assets approximately equal the new issuance of treasury bills?
Charlie, do you want to take that one first?
I'll
Related to your chart?
Start off with that. I would suggest it is largely coincidental. Probably not so much in the first part of this year, when there was the dash for cash. And the bank front-loaded its asset purchases, and it was helpful that it was mopping up the issuance that the DMO had planned. So it reduced any potential stresses in the market. I think it's worth saying that if you go back to the aftermath of the financial crisis during the Great Recession, when we were carrying out QE, there our purchases were again roughly of the same order of magnitude as the extra bonds that the government was issuing. But in terms of actually quantifying how much to do, that the issuance by the government wasn't material. It was how much did we think we had to do to get inflation back on target and so forth. And as I said in my remarks, I think the key thing here is not any close correspondence between the purchases and the issuance, but confidence that they will be unwound in the future if that is appropriate to meet the inflation target, and it won't be hamstrung by the government. So in essence, that we're in a world of monetary dominance and not fiscal dominance. That's the really key thing.
Thank you. There is another question. This one is probably more relevant to Loretta. is about whether the outcome of the forthcoming US presidential election will have any potential impact on the implementation of the new inflation target system for the US Fed.
So no, we take sort of the environment as a given. And, we go into those FOMC meetings trying to set policy to meet our two goals of maximum employment and price stability. And I can tell you, having gone to many, many meetings, even before I became president of the Cleveland Fed, almost 25 years of FOMC meetings, that political discussion doesn't happen around that FOMC table at all. We don't take, anything into account in terms of the elections, in terms of how we set our policy. We really are just laser focused on what's the policy that's going to achieve our two goals, and what's the best way to implement those policies, which tools to use.
Actually, I'll let Loretta off the hook and get back to your last question. I was slow to get in there. What is it a coincidence that the size of asset purchases largely match the issuance around March? I think that's a really interesting research question, as well as a question what happened. But a research question going forward: if central banks step in more to avoid market dysfunction, how much is enough? How much QE is the right amount? When I was at the Bank of England after Brexit, and we did a large QE program, we sat and calculated what we thought the economic effect is, how much stimulus it would provide, and how much stimulus was needed to support the economy to get inflation back to target. It was the old-fashioned way, but that's not what people were doing in March. Then you have to think about things such as what is expected, and you want to do at least what's expected probably by investors, if not more, but then how much more? Again, the old frameworks don't apply at all for that sort of role that central banks may need to play in the future. So really interesting set of questions is how you're going to calibrate that. So recently it seems to just be more each time. So you're constantly surprised on the upside, but yeah, that can't go on indefinitely. How do you calibrate QE for market dysfunction? Really interesting question.
And then a final question, which is about the interaction between monetary and fiscal policies. And there's been very little mention about the consequences of increasing government debt after the COVID crisis, with debt levels reaching historical levels. What we saw after the Great Recession was that in the case of the UK, for instance, very accommodating monetary policy, and at the same time, a period of austerity because of the stabilization objectives. Do you think this is still going to be a big issue after the COVID crisis? Are we potentially going to see fiscal policy acting as a big reduction in aggregate demand, whereas monetary policy will have to step in to do the job? That's probably a question for both, I guess, Kristin and Charles, but also Loretta, if she wants to step in.
Kristin, why don't you see any thoughts you may have on this?
I think what we've learned from this is both fiscal and monetary policy have a role to play. In these sorts of situations, fiscal policy probably has a greater role to play, especially in these types of situations. I think Charlie mentioned this, where you're not sure if the shock is more of a supply shock or a demand shock. Then the role of monetary policy is more limited. Then you need fiscal policy. You can also target fiscal policy when it's certain sectors, certain segments of the population, certain segments of the workforce that need more help. That's something fiscal policy is much, much better at doing than monetary policy. But this is where I think the debate has changed in some interesting ways. Before we used to rely on monetary policy more. Now we still have tools for central banks, but they are more limited. They're probably not as effective as adjusting interest rates. So fiscal policy has to do more. But at the same time, we're also realizing monetary policy might have some role to play in affecting the structure of the economy in ways we didn't think about before, bringing more workers back to increase the labor force, active labor force. And that's a debate we're just starting to learn about now. So the bottom line is they both have a role to play. Exactly which is more important will depend on the circumstance and where the risk is and where the pressure is.
Thanks very much. Charlie?
Yeah, at this point, I guess I'll put my OBR hat on and point out that the key thing about fiscal policy and the extent to which you use debt to finance it, the big picture is that it goes up in war and down in peace. And you can think of the financial crisis and the current pandemic as being sort of similar to wars. They're temporary, big adverse shocks, and it's appropriate that the burden of dealing with them is shared over generations. But the other side of that is that in normal times, it makes sense to be building up some fiscal space, in other words, bearing down on the debt to GDP ratio, so that you've got plenty of room when the next bad shock comes along. And of course, we've had two once in a lifetime or once in a century events in the last 10 years. And if they're going to be coming along every decade, you obviously need to be more conscious of building up that room going forward. The thing that makes life easier at the current juncture for the fiscal authorities is the low level of interest rates. Now, there's uncertainty about where they will go in the medium and long term, but they're likely to remain low in the short term, long-term government yields. So provided governments retain their credibility, their long-term reputation for repaying their debts at the real value that they're expected to, they should be able to borrow relatively cheaply for some time. And that reduces the urgency with which you need to do it. But ultimately, this is a question for government to weigh up the costs of a more rapid consolidation. And nobody suggests consolidation is appropriate now. You wait until the pandemic is in the past. But then the speed at which you bring the public finances onto a sustainable path needs to balance the short-term costs against the longer-term risks if you take a long time about doing it. And I guess the final thing I would say, it's not clear that central banks should be the arbiter of that. I think this is where independent fiscal councils or bodies like the Office for Budget Responsibility have a role to play in commentating on the public finances. If you ask the central banks to do it, you're putting the central banks very much into opposition to the government.
Thanks very much. And last word from Loretta.
Thanks. I totally agree with what Charlie said. The only point I'll add is that if we use our tools appropriately now during the pandemic, i.e., more fiscal policy in the wartime scenario that Charlie was saying, coupled with monetary policy, we will get to this, we'll have a much better economy when we get through it, so that we can take on some of the structural things that we have to deal with, including looking at structural deficits. So I don't think holding back now on these tools is the appropriate thing to be doing, because we need to get to the end of this so that we actually are in a better spot, and prolonging, a long recovery and a sloggy recovery that isn't strong doesn't really serve the purposes of the long-term goals either.
Great. Well, I'd like to thank all the speakers for a really interesting set of presentations and a really fascinating discussion following. So thank you all for taking part.